You have questions, we have answers. Back with another quick clip. My name is Brian Leitner, and today I'm joined by Tony Roberts in our Cincinnati, Ohio office. Tony, thanks for being here today.
Thanks, Brian.
So Tony, your question for the day that came in was, with interest rates being so low and fixed income offering, just a really low return, should I consider exiting my fixed income portfolio because I'm beginning to question, why I even have fixed income, with these poor returns? What are some of your thoughts on that?
Yeah, Brian, it's a good question. It's certainly a logical question today with low rates of return on fixed assets, as you mentioned. I think the most important thing for investors to consider with this question is we don't just look at expected rates of return when we make an investment decision. If we were just looking at expected rates of return, we would be taking a lot of risk in portfolios because risk and return are closely correlated. We have to consider the other dimension, and that is risk and the benefits that come with asset class diversification and with owning assets that have lower volatility. And that's where I think we often miss that side of the equation when we look at the low rates of return on bonds and think, should I own any? I think there are real benefits. And a good example of that, Brian, we can all remember 08-09. When the equity market was down 50% at its worst moments. If an investor at that time had a portfolio that was balanced, 60% equity, 40% bonds, and they maintained that allocation throughout that period and through the recovery, their portfolio recovered its full market value about 1.5 years before a portfolio of all stocks. And that didn't happen because bonds were paying a nice rate of return. It happened because bonds held their value better in that down market, and that gave the portfolio a better opportunity to appreciate when the market began to go up.
So in other words, perhaps instead of looking at it as if your fixed income portfolio is going to give you a great return, maybe looking at it as an attribute of a volatility dampener within the portfolio. So less ups and downs throughout that time frame, if you will, right?
That's right.
So if individuals aren't receiving that type of return in the fixed income space, what should they be thinking about as it relates to ways to generate income off their portfolio if bonds, from years ago was maybe that route that a lot of people took?
Yeah, and we do have a lot of clients that are looking into other asset classes to generate a stream of income. And there are certainly other asset classes that can provide that. Stocks are a good place to start, Brian. Right now, better than 70% of the companies in the S&P 500 pay a dividend that's higher than the 10-year Treasury rate of return. Not to mention the majority of those companies also grow that dividend every year. So, that may affect asset allocations to generate that increased stream of income. There are a lot of alternative assets that provide a higher stream of income as well. And so I think those are all very valid considerations, but the key thing to remember for investors that are doing that is those higher interest-bearing equity investments carry with them more volatility and potentially more risk for the portfolio.
So to your point, it's all about balance. And the reality is, as always, diversification is key. It's not just stocks, it's not just bonds, but there could be real estate, there could be currency, there could be just so many other attributes depending upon, again, what the profile is of that individual and what they're trying to accomplish.
That's right.
That makes a lot of sense. Tony, thanks again for being here. Really appreciate it.
Thanks, Brian.
And if you or anyone else has questions they'd like answers to, please feel free to email us at qa@marinerwealthadvisors.com. Thanks for watching.